Australia has long positioned itself as a land of opportunity, a magnet for skilled professionals and entrepreneurs. But the nation now finds itself at a crossroads. While the government claims to be modernizing the tax system and ensuring fairness, the reality is that the upcoming tax reforms for 2026 could dramatically reshape the economic lives of millions of Australians both at home and abroad. The implications are far-reaching and, for many, deeply alarming. This is not just a policy update. It's a total reimagining of who pays what, when, and how, and the result could make life in Australia not only more complex but financially unbearable for the average person. At the heart of the reforms lies a move that many experts warn could trigger an exodus of capital, talent, and ambition. One of the most controversial proposals is the taxation of unrealized capital gains. Yes, you heard that right. The government is considering taxing individuals on the paper increase in the value of their assets, even if they haven't actually sold those assets or received any profit. This would affect homeowners, small business owners, retirees, and investors alike. Imagine your house value rises, but you haven't sold it. You could still be taxed on that increase. It's like being billed for money you haven't even touched. But that's not the only alarming development. New tax residency rules will make it significantly harder for Australians to avoid being taxed, even if they live overseas. Under these changes, simply spending 45 days or more in Australia in a financial year or maintaining ties like a home or family in the country could make you a tax resident again. That means Australians living and working abroad could find themselves paying Australian tax on global income, despite already being taxed in another country. Dual taxation threats, costly legal battles, and increased surveillance by the Australian Taxation Office, ATO, are already becoming a concern among expats. One high-profile case involved an Australian engineer living in the UAE who received a massive tax bill after briefly visiting family in Australia and keeping an Australian bank account. These kinds of scenarios are no longer rare, they're becoming the new normal. For digital nomads, retirees in Southeast Asia, or Aussie professionals building careers overseas, these laws represent a ticking time bomb. Back home, the situation isn't much better. Small business owners are under pressure as the ATO tightens its grip. Long-trusted strategies such as income splitting through family trusts are now flagged as potential tax evasion tactics. New audit processes are more aggressive, and compliance rules are increasingly complex. Entrepreneurs are finding themselves spending more time with accountants and lawyers than running their actual businesses. Meanwhile, the proposed increase in superannuation tax rates, particularly on balances over $3 million, represents another blow. These changes could penalize people who have simply followed the rules and saved diligently their entire lives. What was once a promise of retiring with dignity is now becoming a warning to save at your own risk. There's also talk of future inheritance taxes, something Australia has so far avoided. But with wealth increasingly locked in housing and retirement accounts, there is mounting political will to unlock that gold mine. And let's not forget bracket creep, the silent killer of take-home pay. As inflation pushes wages up, more Australians are being bumped into higher tax brackets, even though their real purchasing power hasn't increased. A nurse earning $85,000 could soon be taxed like an executive, despite no change in lifestyle or savings potential. There's no adjustment for inflation in the tax brackets, and that's eating away at the middle class. What's most frustrating for many Australians is the double standard. While everyday people face rising taxes and complexity, large multinational corporations continue to legally avoid billions in taxes through international loopholes. It's a stark contrast that's fueling public anger and disillusionment. All these factors are driving a quiet migration of wealth and talent. Increasingly, high-net-worth individuals and skilled professionals are relocating to more tax-friendly countries like Singapore, Portugal, or New Zealand. These countries offer clearer regulations, more stable tax systems, and a more supportive climate for innovation. And when these individuals leave, they take their investments, their jobs, and their economic contributions with them. This isn't just brain drain, it's capital flight. So, what can the average Australian do? First, get informed. Know how the new rules around residency, capital gains, and superannuation could affect you. If you have international ties, whether through family, work, or property, speak to a tax professional as soon as possible. Second, think globally. If you've ever considered working or living abroad, now might be the time to seriously consider your options. Some countries are offering digital nomad visas and expat incentives that are far more favorable than what Australia is proposing. Third, take action. Write to your local MP, support candidates advocating for fair tax reform, and join in public consultations when possible. The truth is, Australia is approaching a dangerous fork in the road. It can either reform its tax system to reward hard work, savings, and entrepreneurship, or it can continue down a path that may push its best and brightest away. As things stand, by 2026, we could be living in an Australia where only the ultra-wealthy and politically connected can comfortably remain. For the rest, the tax burden may become too heavy to carry. Thank you for watching. If you found this deep dive helpful, subscribe to my channel for more critical updates on Australia's changing financial landscape. And if you want to understand how mass immigration policies are further straining our economy, check out the next video right here.